The accounting equation is something we came across when we looked at owner's equity, but now we just need to talk about it as a relationship between assets, liabilities, and owner's equity. And it's going to be very important for everything we do. So basically we want to remember that the accounting equation is assets equals liabilities plus owner's equity. And you can apply it to basically anything. So let's say you needed $2,000 for a new iPhone, but you've only got $500 in your bank account. So this is what you want. This is an asset. It's called an iPhone. But you don't have enough money. So to make up the difference, your parents give you $1,500 as a loan to buy the phone, and you can repay it at a rate of $100 per month. So that's a liability or a loan, just like businesses have. So what we've got here is the asset, $2,000. That's the iPhone. Equals your liabilities, $1,500. That is your obligation to other parties for the asset. Plus $500. Now, when we looked at the definition of owner's equity, we said it's the owner's residual interest in the assets of the business, and that kind of makes a little bit more sense now because we can see the asset is $2,000. $1,500 of that is claimed by your parents because you've got to pay them back. So your residual interest in that phone is $500, and together $1,500 plus $500 equals $2,000. So it can also be expressed another way that we're going to talk about, which is owner's equity equals assets minus liabilities. We're going to need to know both in quite some detail. And just to sort of like apply that to the phone we spoke about, in this case we said the asset was the $2,000 phone. Take out your debts on that phone, which we call liabilities, and your owner's equity was $500. So that's the second way we can express the accounting equation. It also applies for big things like when you buy a house. So you hear people talk about houses and what's your equity? Can you borrow against your equity? Well, what that means is this. It means you decide to buy this house here worth $900,000, but you've only got $200,000 in the bank. So you borrow the remaining $700,000 from the bank. So the accounting equation is always true. It's simple, but it's always true. Assets equals liabilities plus owner's equity. You get a $900,000 house equals the debt against the house, which is $700,000, plus your owner's equity, which is the money that you put in, $200,000. And then, just like in business, over time the accounting equation will change, and it must always balance when it does change. So let's have a look. Here's what we've got. Assets, liabilities, owner's equity. You've got a $900,000 house, $700,000 debt, $200,000 of owner's equity. And then let's say in year one, you repay $50,000 off that loan. And let's assume the value of the property doesn't change. In the real world, property prices change, but let's say it's still worth $900,000. You've paid $50,000 off the loan, so this must go down. You don't owe the bank $700,000. You only owe them $650,000. So therefore, what you've just done by paying off some of the debt against that asset, you have increased your equity. So together, $650,000 plus $250,000 equals $900,000. Then in year two, you repay another $50,000. Well, that same thing happens. The house is still worth $900,000. You don't owe the bank $650,000. You only owe the bank $600,000. And what happens is your equity goes up against that asset year three. And at the end, let's say there is a property market crash and the value of the property falls to $400,000. Well, the problem here is when property prices do change, it's not like the bank says, well, hang on, the property's only worth $400,000. You can just pay us back that. No, the bank still wants its $600,000. And what you'll end up here, this has to be a negative number. And what that means is you've got negative owner's equity, which is about the time when you declare bankruptcy. So if you ever hear the phrase bankruptcy, one strong indication of being bankrupt is you've got negative owner's equity. And that happens when the value of an asset falls below the amount that's owed against it. So just to summarize what we've done, the accounting equation can be expressed in two ways. There's also a third way if you want to be fancy, but we don't really use it. So let's just have a look. The first way we'll use the most is assets equals liabilities plus owner's equity. We'll also use owner's equity equals assets minus liabilities. And maybe there might be a calculation required. It's very unlikely, but you might need this third one, which is just where you rearrange it and say liabilities must therefore equal assets minus owner's equity. But don't worry too much about that last one.